Welcome back to Chapter 1 and the Introduction to Financial Statements. In this video, we'll cover learning objective number 2, where we'll explain the 3 principal types of business activity. All organizations, whether it's a business or not-for-profit, are essentially involved in 3 basic types of activities: financing, investing, and operating. The first 2, financing and investing, determine how an organization is funded so that it can be able to operate or do what it does. And the accounting information system keeps track of the results of all of these different business activities and then tells a story and reports on it. You'll also see these 3 activities again when we review the cash flow statement, which tells a story of how money is generated from or used by each of those activities. Businesses basically derive funds from one of 2 sources. The first is debt and the second is equity. Debt's basically borrowing money. We call debts liabilities. They're amounts that we owe to other parties or creditors. Common forms of liabilities include notes payable, bonds payable, mortgages, long-term loans, those kinds of things. And as previously mentioned, the second source of funding is equity, or usually shares or stocks that are sold for cash. You're probably familiar with the term common shares or common stock, and that's simply the amount paid by shareholders or stockholders for shares that they purchase. Another type of share is a preferred share or preferred stock. And then any payments to shareholders or stockholders are called dividends. There are common share dividends or preferred share dividends, and dividends may be cumulative or non-cumulative and participating. There's all kinds of special circumstances that can exist with stocks. The next activity is the investing activity, and this is where the company invests or purchases the resources that are necessary to be able to allow it to operate. So companies and not-for-profits also will purchase computers and trucks and factories and buildings and all kinds of resources in order to be able to do the business that they do. And so those resources that are owned by a business are called assets. Another example of an investing activity is investments themselves, where companies with excess cash may invest in things like bonds or in shares in other companies to be able to make a little bit of extra money or investing income. And the last activity is often the biggest one, and that's the operating activity. So once a business has obtained the financing it needs to be able to purchase the assets that it needs, it can then begin its operations. And within its operations, what it does is it generates revenue and incurs costs. So for-profit businesses will sell products or services. Not-for-profits will derive revenue from donations or fundraising drives, those kinds of things. In essence, revenues are the increases in assets or the decreases in liabilities that result from the sale of goods or performing services over what we call the normal course of business. And common sources of revenue will include sales revenue, product revenue, service revenue, interest revenue, rent revenue. It all depends on the nature of the business. Now, in addition to revenues, organizations will actually employ certain assets with short lives called working capital in order to run the business, in order to operate. Some of those assets will include supplies that are used in day-to-day operations rather than sold to customers. Of course, we have inventory, and those are goods that are available for customers to purchase. And then we have accounts receivable. So in a lot of cases, sales are made to customers. We don't collect cash from them right away. We extend them credit terms. And so the right to receive that money from a customer in the future as a result of that sale is known as an account receivable. Now, in order to generate revenue, businesses must also, unfortunately, incur costs, and those costs are called expenses. Expenses are the costs of assets that are consumed or services used in order to generate revenues. Expenses can include cost of sales, selling expenses, marketing expenses, advertising, administration, income taxes, interest expense, all of those wonderful things. In addition, liabilities also arise from expenses. So if we have income taxes that we haven't paid yet, we now have an income tax payable liability. If we employ employees, and of course we don't pay them every day, we usually pay them semi-monthly or bi-weekly, well, unpaid wages are called wages payable. If we collect sales tax, it has to be submitted to the government authority, like a provincial sales tax or the GST. We have sales tax payable. All of those are liabilities related to expenses. And then we have net income, and hopefully businesses has net income, and so that's when your revenues exceed your expenses, including taxes. And then, unfortunately, businesses may actually incur more expenses than revenues, and that results in a net loss. So that concludes Learning Objective 2 on the 3 principal types of business activities. Please proceed to the next video for Learning Objective 3, where we'll look at the 4 major financial statements and how they're prepared.